Hello traders, it's Wednesday, January the 15th. This is John Kicklighter, Chief Strategist for DailyFX.com. Here with the FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in the 24 hours ahead of us. Now we've had a substantial opportunity through the opening 24 hours of this week where we had a change in activity which introduced us to the possibility of much more significant moves and trend development later down the line. However, that jumpstart that we had and the big drop in equities and the big drop in yen crosses did not immediately sustain itself. In fact, this past session we had something of a pullback. So we are still reaching out for the necessary activity levels to meaningfully alter our congestion, our complacency, and introduce new trends. All right. So through looking and evaluating the backdrop of activity for the markets, we have first here the S&P 500. Now this is my preferred measure of risk trends, and this is where we had a lot of activity and a lot of the excitement for the possibility of something more substantial from these markets to open up the week. When we were looking for this benchmark, we did have a remarkable 1+ percent decline on the S&P 500. We had a similar situation from the Dow Jones Industrial Average. Now these two indexes are good measures of risk trend, so their subsequent decline was of significant interest. All right, we were looking for these potential declines to give us the necessary progress to speak to a much larger reversal, because the reversal of a trend of this magnitude certainly carries with it very substantial trading potential, not just in the capital markets, but in the FX world as well. That was the foundation, in fact, of the trade that I had picked up at the beginning of this week, the dollar-yen. At the very opening of the week, with equities and equity futures declining, we saw the dollar-yen making a break of this flat, you could call it a neckline on a head and shoulders pattern here, at about 103.85. Now that breakdown encouraged me to take a short. All right, it wasn't a significantly large size short. It wasn't one that I was willing to build up into similarly back trades like other yen crosses, but it was the first move, the initial move, one that could potentially develop into something more pervasive and offer a bigger trend. But as you can see, we actually had a bounce. This is the same kind of circumstances we have here with the S&P 500. These are not necessarily directly related, but they are related to the underlying driver, risk trends. All right? Because these yen crosses are heavily influenced by the same circumstances that the benchmark equity indexes are, the global equity indexes, and that is the assumption of risk appetite. In a low-risk world where volatility is seen to be exceptionally low, or the presumption of individuals' risks are seen to be low, investors are more encouraged to take risk on going along the standard high-return asset. And for the FX market, that is a carry trade. All right? And that's why we have such a strong correlation between pairs like dollar-yen and benchmarks for risk like the Nikkei 225, or, if you will, the S&P 500. All right? But turning the trend on the dollar-yen is just as difficult as turning the trend on the S&P 500. And in many ways, actually, the yen crosses are more difficult to turn around than the S&P 500. The S&P 500 is a beast of consistency. It is one of complacency. And the familiarity of that bull trend is much more difficult to turn, especially when we still lack for a substantial level of participation. We know that these markets are still running on relatively thin participation. To turn a prevailing trend of this magnitude takes not just conviction, it takes a lot of unwinding. And a lot of unwinding means higher volumes and higher open interest. We don't have that yet. But it was the first potential move in that direction. Seeing some progress to this technical drop that we had here was the first step. All right, that's why I took the dollar-yen. Now, what ultimately led this to hit the stop at 104.30 is the return to that prevailing trend. All right, if we had the follow-up step, which we were talking about when I took the trade and as I was holding it, the follow-up step would not necessarily be the other aspect of this, relative monetary policy, because while the Bank of Japan's monetary policy expectations are still into the future, we still know that there is a heavy expectation that come April, that the Bank of Japan will materially upgrade its stimulus program. And when the Bank of Japan upgrades its stimulus program as any central bank, it will materially devalue the Japanese currency. So this is enticed to continue its persistent move higher, as would all the yen crosses be. All right. On the opposite end of that spectrum, and something that did materially help in the dollar yen's break initially to the downside, would be a dollar decline. However, the dollar's move to the downside is more hemmed in by congestion, and subsequently the fundamental outlook actually does not materially support the dollar selling off individually, because we are talking about taper speculation. We'll talk about what the dollar has to look forward to and what it did respond to this past session to help it bounce off of that range support. Right? But to see the yen crosses continue to the downside, we need to see the same thing that would support the equity markets, not just US-based, but Asia-based and also European-based. Actually, the FTSE 100 is still at the top of that range. But to see all these equity indexes drop to the downside, we need something that materially alters our bearings for complacency and the persistent bull trend into something that is deleveraging and risk aversion. All right? But we would not see that. On the docket this past 24 hours, there were a range of notable pieces of event risk, but nothing that would materially tap into the well of fear. All right? We did have a couple things from Spanish housing, which is an ongoing uncertainty and something that Euro traders should take note of. We did have a number of concerns coming out of the ECB, the ECB President Trichet's suggestion of the Troika and his performance, and there was a document released from the ECB itself in which they were concerned about the stress tests and the validity of the stress tests. We did have a couple of indicators that would undermine confidence. We even had a couple very noteworthy pieces of, or noteworthy speeches from two hawkish monetary policy officials, both voters. And all of that would give some shift in expectations, but nothing would really hit the peak that the market would seemingly need to truly change the bearings on risk trends. So, without a material push towards risk, or risk aversion more appropriately, we wouldn't see the dollar yen capitalize on its break to the downside. We wouldn't see the pound yen. We wouldn't see the euro yen. None of these carry trades, these overwrought carry trades, would be able to unwind. And instead, we'd transition back to the consistent and quiet and slow theme of an expectation for the Bank of Japan to eventually upgrade its open-ended stimulus program. All right? So we need something that materially puts into motion the risk theme. Now, ultimately, it can be something that isn't data-based. It doesn't have to be a comment-based. It doesn't have to be one event that all of a sudden changes the entire backdrop of the market. It can be a cumulative change in expectations. It can be a cumulative expectation for risk aversion. Once you start that moving in that direction, it's actually not very difficult to start a cascade effect, because we know that there is an exceptional exposure to risky assets. All right, I think that the S&P 500's general position would reflect that, but we also have exposure to junk bonds, high yield assets, and many other markets that are easily qualified as being risky. We also have a exceptionally high level of leverage, a record level of leverage on a equity basis. We also have an exceptionally low and record low level of free cash to cover margin calls. All right, these are all very risky conditions, but they aren't necessarily the catalyst that actually cements a turn in sentiment. So when looking at this trade, I am not necessarily upset that the dollar yen stopped me out at 85 pips. This is a trade that had great potential, but it was a tester position. I want to see those risk aversion themes kick in, and when they do, they will eventually offer a lot more opportunity to the downside, but I have to be patient. Patience is important, and it's best not to try to strong-arm a trade, especially one that goes against the prevailing momentum for the backdrop on sentiment. Now, I still think that the yen crosses do have considerable potential to break to the downside, as does euro-yen, as does pound-yen, all right, to hold that former trend line there and potentially drop back to the downside. But I think that risk trends in general have great potential. The question is not whether there's potential, but when it will actually unfold, and that is my greater concern. You can have a pullback if this previous swing here holds and we are getting lower highs. That would be an indication that we are potentially trending towards a bearish market. However, it has to be something that is tradable. If I see a break to the downside, new lows from the S&P 500 or other benchmarks, then I would be encouraged to start picking out better risk-based trades. But until we actually see those themes, this is going to be a little bit more risky. In the meantime, the dollar-yen is truly going to require some measure of risk aversion, because we're talking about the dollar looking more towards taper, and that's a bullish push for the US dollar. This is not necessarily the best pair to play without a risk aversion, a sound and aggressive risk aversion theme in play. So why did I take this instead of the others? Because I like the technical bearings a little bit better, and the fact that the US dollar was breaking short-term trend line support here. All right. So, going forward, my yen cross interests might change a little bit. I might be looking more to the euro yen and pound yen if I'm looking for continuation to the downside. But truly, this really depends on full scale and confidence affirming risk aversion. Now, looking at the next 24 hours, do we necessarily have a lot of event risk that can stir that underlying sentiment change? No, we don't. We had some World Bank forecasts, which were of considerable note. That's why the Aussie dollar is actually dropping in the early session. We have a couple indicators. We have earnings from a couple of major financial houses in the United States. We even have a couple of policy officials, Fed officials, talking tomorrow. But these aren't the scale, the level necessary of single-handedly driving risk aversion. Especially not the policy officials, because those are two non-voters, and these were two voters, and they said some pretty provocative things, which we'll cover in just a second. But there isn't the level of risk aversion threat that we see here. All right. If that's the case, a couple pairs, we can start looking for positions that take advantage of that congestion. Are there risk-sensitive currency pairs that are holding to ranges that offer some better opportunities there? Rather than look for breakouts, look for the lower path possibilities. Well, there are a couple pairs that were not in the running for my initial move, but if we're talking about the possibility of a congestion setup, I like actually the Aussie yen. This is a 4-hour chart. We've been paying much more attention to this and seeing the possibility of a breakdown. Yes, it still has great potential for a breakdown if risk aversion kicks in, but if risk aversion does not kick in, there's a nice range here. It might only be 80 pips. But hey, I'd rather take a high probability, smaller return than try to leverage or ramp up a low probability, higher return trade. Okay, so that's what we can see here. If it is risk aversion, if we do have another round of that and the Nikkei 225 drops off, the S&P 500 drops off, European indexes drop off, we might break that 93 finally. But if not, we have a nice consistent range here. The same thing could be said of the Kiwi yen, right? Very consistent range, very consistent. And if we are trading within this range, there's certainly an opportunity there. But if we do break, you can see that this has been building up pressure for quite some time. This might not necessarily need the full-scale risk aversion theme to ramp up a break if it happens technically. Though, of course, if I were looking for follow-through on any of the yen crosses, I absolutely need to see a confirmation from risk trends. But as we know, risk trends is only one of the two major themes that we are paying attention to as of late. The other major theme is relative monetary policy. All right, so we are keeping a very close eye on those rate expectations and stimulus expectations. The dollar yen does not support a drop to the downside on pure monetary policy. I was fully expectant or is fully dependent upon risk trends, right? Because that Bank of Japan expectation of ongoing stimulus helps to support the yen crosses higher. The dollar is looking at a possibility of taper. In fact, the dollar itself had a very significant level of support on the taper front from this past session's two monetary policy official speakers, Plosser and Fisher, both known hawks and, more importantly, voters. They had some very interesting things to say. From Fisher, we heard that he preferred a $20 billion taper when the central bank actually announced his $10 billion taper, and that even if he saw a decline in the S&P 500, that would not encourage him immediately to pull off of a vote for taper. He would continue the taper even if he saw the S&P 500 dropping. That is a very interesting consideration, and that is something that, while the markets might not expressly know that they're concerned about, that is certainly something that is priced into the model. The concern is that the expectation is that if the S&P 500 starts to drop off, market instability would in turn encourage the central bank to act to stabilize the market, which would naturally keep this relationship here between the Fed balance sheet and the S&P 500, as they are targeting volatility and, in that assessment, market stability. However, if Fisher is suggesting that that's not the case, then the market will certainly be more concerned that as volatility rises, it will continue rising. And that means that as the S&P 500 drops and risk drops, so too would we see that theme carry momentum. All right. Now, obviously, he's a little bit more hawkish than your average monetary policy official, so we have to see that sentiment shared by other policy officials. But I think Plosser's commentary on the day was also worth mention. From Plosser, he had some very interesting things to say, actually. He was suggesting that not only did he see 3% GDP, 2% CPI, and 6.2% unemployment rate through 2014, he also said that we shouldn't read too deeply into the December non-farm payrolls. Those December non-farm payrolls were a big miss, and that was a big component of the dollar's recent drop. The expectations that the taper could be slowed. His sentiments are generally reflected from what the policy officials have said so far, that they are still on pace to continue tapering, despite the non-farm payrolls. Now, of course, if the non-farm payrolls continue to miss, that would be very conducive of a trend, and they would have to rethink their position. But in the meantime, Plosser also said that the threshold to stop the taper is pretty high. All right. So the Fed is more likely to continue with those $10 billion taper decisions in subsequent meetings. Next one being January 29th. Mark it on your calendar. All right. So that is encouraging of the U.S. dollar. But is that encouraging enough to drive us through this short-term resistance? All right. What could accomplish the drive to that short-term resistance is more meaningful risk aversion, because the U.S. dollar as a safe haven would benefit quite substantially from that appetite drive, and we would see that the big swell in demand for treasuries, medium and long-term treasuries, which will pull down these yields but ramp up those treasury products. So here's the treasury futures and treasury ETFs. These reflections or derivatives of treasuries would rise, and in turn the US dollar would rise alongside them. Okay, actually the dollar would rise first because people have to buy dollars to buy treasuries. But that would be a bullish factor for the US dollar. But in the absence of the big risk aversion theme, which we would love, but it's not necessarily taking root, we can still see that the taper expectations can be beneficial. We just have to be able to pick our currency pair properly. Against the Japanese yen, that is actually a positive bearing, but I'm not very confident in the risk positive outlook. All right, I'd prefer a pair going forward, or in these circumstances where risk aversion is not heavy, where the dollar would benefit from its risk aversion theme and the taper theme. All right. That being the case, euro dollar is a possibility. It is sitting here at this congestion level at about 136.25, 136.35. All right, that's short-term support, and we have seen that the interest rate forecast for the euro is actually easing back a little bit. The European docket was not very encouraging this past session. We did see that there was actually a statement or document from the ECB that noted concern related to the stability or the validity of the financial stability or financial stress tests that they were doing in the banking sector there, and that's because of different measures of credit quality. But we are definitely seeing euro confidence backing off. If you want to see more about the euro specifically, I did do the today's strategy video about it, and we talked about the incredible investment wave into the eurozone from other regions. This is the 2 and 10-year 2-year Treasury yield for Spain and Italy. You can see they hit record lows, and that's capital flowing into those riskier assets and really reducing the premium, the risk premium, down to zero. Meaning people are overextended on these assets, just like they're overextended on equities, all right, and carry trade. Just as exposed to volatility as anything else, but until it actually occurs, it's not necessarily a direct threat. But we're starting to see those interest rate expectations change. Those expectations for return on European assets change. And that, paired against the US dollar, is a little bit better. Now, a break below this little pivot level here is not going to open up much in the way of follow-through. The real move would be below this 135.50 level, but that would also have to come alongside a dollar rally to the upside, breaking its own resistance, which has proven very difficult to do. We already know the taper is priced in. Maybe the market's not fully appreciating it, but what would encourage them to actually do so in the next 24 hours? That's what we have to consider. Now, in terms of the pound US dollar, this is a pair that I think has great potential. A break here is easy enough to encourage, and this past session we did have some very noteworthy data. Now, we've seen the data disappoint on the UK side for a number of weeks now, and the market has not seen its interest rate expectations diminish for the Bank of England. Well, those interest rate expectations have pushed the forecast for a possible rate hike as early as 2014. Right, that's more aggressive than the Bank of England has suggested. Well, the inflation figures that we have seen this past session do not seem like they're going to force the Bank of England's hand, even when we hit that 7% unemployment rate threshold that they are targeting. That is a very interesting outlook that is going to significantly undermine the expectations for rate hikes from the Bank of England. So we can see that that recent pop is going to start pulling down. The 2-year yield differential is more likely to continue its pullback. However, we have to wait to see that play in because we did not have an immediate reaction to the CPI data. We're slowly undermining those expectations, those hawkish expectations. It seems to take time, but be very careful because I do think that this can change pretty quickly. All right, because we have had 6 months of buildup on interest rate expectations. This is why the pound has been strong, not just against the US dollar, but against the euro, against the yen, even against high-yield currencies like the Australian dollar and New Zealand dollar. And that strength has come from those interest rate expectations. As they start to devolve, as they start to erode the foundation, we have a potential for a break. So with the US dollar lean and the pound lean going in opposite directions of the policy spectrum, Fed exceptionally dovish, going back towards neutral with the taper. Bank of England expecting a hike earlier than, or the market expecting a hike from the Bank of England earlier than the Bank of England itself is willing to even consider it. There is a possible ability of moderation, and subsequently that would equate to a bearish move possibly for the pound dollar. Now, I'm being patient. I'm waiting for it to actually take root, and risk aversion would help here, but this is not necessarily a very sensitive risk-based pair. I'm looking for a 163.50 break, then a 162.50 break, and seeing if this relative monetary policy theme can actually develop. All right, but I'm waiting for those breaks. Good opportunity there. Good changes. There's a lot of interest and a lot of opportunity in many pairs. Monetary policy, risk trends. Monetary policy probably has more of the potential looking at pairs like Pound Aussie and Euro Aussie and Euro Kiwi. Lots of interesting opportunities here. Aussie Kiwi and Aussie CAD definitely. All interesting, all have great potential, but we have to make sure that we are setting reasonable expectations in terms of trade potential, and we are looking for reasonable stops. Reasonable stops, reasonable targets, reasonable time frames. We have to be able to find something that we can get with a high level of probability. Full-scale risk aversion, not unless we have the technical break that we tentatively have followed up with follow-through. All right, and we have not had it yet. Meantime, we got to look for pairs that potentially can cater towards alternative conditions of congestion and consistency. If that's the case, there are options for that as well. So keep those options in mind, but also keep those triggers, fundamental and technical, in the immediate foreground. If you see those cues, your trade approach changes. All right, but in the meantime, stick with what's probable. All right, I'll update you on these markets once again tomorrow. In the meantime, good luck trading out there.